For most Americans, automobiles are often either their largest or second largest household asset, and most cars are purchased with the help of a car loan.
People are taking out car loans at interest rates that are much higher than they could have gotten if they had just shopped around more.
That was the conclusion of a new study done by Christopher Palmer at the MIT Sloan School.
So what we looked at in our research is how people shop around for car loans and the degree to which they do shop around for car loans. We're looking at decisions that individual borrowers are making. We had millions of borrowers in all 50 states, and we're looking at how they decide what interest rate they want to take. And the biggest punchline that came out of our research is that most people do not shop around for car loans. They take the first interest rate that's offered to them, and in so doing, they end up missing out on a lot of savings or the opportunity to buy a nicer car.
There are several mistakes that consumers make when shopping for a loan. They fail to shop around or mistakenly assume that the bank or dealer will always offer their best deal.
When we've looked at why people might be making these mistakes and not shopping around, there are a few things that have come out. One is that people just don't realize there's any reason to shop around. In their mind, there is an interest rate out there for a car loan, and it's personalized to me because of my credit score, and it is what it is, no matter who I get that interest rate from. So people might not realize that there are benefits to shopping around. Other people think that they don't need to shop around because the dealer is going to give them the best rate, or you have to finance your car through the dealer, or their own bank is going to give them the best rate. So one of the things we were able to learn about in our study is what it would take to find the best interest rate for you. And on average, the borrowers in our study, if they had just gotten 3 or 4 quotes from lenders, they would have found the best rate that was available to them.
Consumers may also just not appreciate how much money can be left on the table with a poor interest rate. Or they may choose to buy a less expensive car to make up the difference between the purchase price and the rate on the loan.
Leaving a better interest rate on the table matters because you might pay a lot more over the life of the loan, or you might not be able to afford as nice of a car as you would have if you had shopped around and found the best available rate for you.